Hello, everyone. Thank you so much for joining us today. I'm Marche, the Webinar Director at Advice Chaser, and I'm very glad to welcome you here. Before we introduce our guest and get started, I do need to do a little bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. Well, we're thrilled to bring you this educational presentation today. Just a couple of items that attendees need to know. You folks are on mute, and we're happy to answer questions, but you need to do so using the chat box. So go ahead and use that chat box today if you want to ask a question. If we're not able to get to your question today, we'll make sure to reach out to you after today's event, but we will need your contact information. So remember to put your contact information in there if we're not able to reach out to you after, or I'm sorry, if we haven't been able to get to your question during the presentation today. We want this experience to be as educational as possible. So again, please don't hesitate to ask for clarification or expansion of the material. Well, I'd love to introduce you to our speaker today. Eric Maldonado is the owner and founder of Aquila Wealth Advisors, LLC, in San Luis Obispo, California, established in 2017. Eric has over a decade of experience providing financial planning and investment advice. He is a fiduciary financial advisor and a fee-only financial advisor. That means Eric and his team work under a fiduciary standard of care, putting their clients' interests first, and their compensation method is the most transparent and objective method available. Eric earned his MBA master's degree in financial planning from Indiana Wesleyan University and his bachelor's degree in business administration finance from Cal Poly San Luis Obispo. In addition, Eric has designations of Certified Financial Planner Practitioner and Certified Exit Planning Advisor. He has earned the Certificate in Blockchain and Digital Assets and is a member of the Digital Assets Council of Financial Professionals. And Eric, we're excited to have you back. I know that we have lots of people who are ready to be educated on all the different types of retirement plans out there. So I'm going to turn the time over to you.
Hi, Marche. Thanks for having me. And hello to everyone there listening live here or on the recording later. Thanks for giving me your attention here. And I look forward to answering your questions. As Marche mentioned, feel free to type in questions and we'll get to them. And that's one of our favorite parts. So we'll answer all your questions and get going here on retirement account planning. All right, let's look at the next slide, Marche. So don't let this overwhelm you. This is just a plethora of retirement accounts that are available. You got IRAs, 401ks, 403bs, steps, simples. I'm sure you've heard of these, jargon, nomenclature, numbers that mean nothing, but they're IRS codes, or IRA stands for individual retirement account. So we're going to cover them, but that's the smattering of options available. Let's go ahead and dive deeper, Marche. This is a defined benefit or a pension plan. There was a time when most Americans got a pension plan with their employer. Back in the 80s, I think like 60% of workers had a pension plan, which is basically a defined income you're going to get every month upon retirement. So, you work for one company or one organization, entity, a government, or a nonprofit, and the time that you work equates to income paid. There are still some today, of course, if you work for various city organizations or counties or hospitals or even some of the bigger organizations that have been around for a while, publicly traded companies. but maybe like 4%, I think is a quote, a stat I saw, of people working today have access to a pension plan from their employer. Now, there are ways to essentially buy your own defined benefit plan, create your own pension. So if you're maybe a high earner and you have, maybe one or two employees, that's kind of the sweet spot, because you can essentially super fund or put a bunch of money every year into your own pension that you can then pay yourself out later, and you still have to match your employees at a certain percentage. So the sweet spot is kind of when it's one high earner with one or two, admin or assistant people, and you can create a pension for them and for yourself. So that's the pension and defined benefit concept.
But you're saying this is not really common. So
yeah,
unfortunately, most people won't have access to this.
Yeah, if you're a teacher, you have access to a pension usually. But if you're just a regular worker like myself, business owner, pensions aren't really a part of the equation. But that's where things like IRAs come into play. An individual retirement account is what it stands for, and it's separate from your employer. So you set it up as your own entity. You the person. It's for your benefit. And a traditional IRA is the one that's been around longer. It's pre-tax. So you put money in today up to $6,000 in 2022, and you get a deduction on your tax return. You deduct that from your income. So you kind of get an incentive on your taxes when you put it in, assuming you're, within the income parameters. And then, but the caveat is when you go to take the money out one day after your age 59 and a half, that money is then taxed. So all the money that comes out of the IRA is taxed at whatever income bracket you're in, in retirement. So, that's why they call it a tax deferred plan, because you're basically deferring the tax down the road, and whatever amount is in that IRA, as you pull it out, that money is going to hit your tax return as taxable income. And then there's also something called required minimum distributions, which these days at age 72, if you're 72, you have to start taking out a certain amount every year based on some of the IRS guidelines on your age. That you have to start taking out to pay tax on, because the government wants their tax money, so they gotta start forcing people to pull it out, even if you don't necessarily want to. So that's the traditional IRA.
We did have a question here. Why is it called traditional?
Well, traditional is just because it's the one that was the first one. So it's a way to distinguish between the Roth IRA, which is we can talk to later, but pre-tax, some people just call it an IRA or an IRA. You might hear that word, but it's just meant to say like it's the original one, pre-tax.
Okay.
Yeah. And then 401k plans is probably the other most popular retirement account that we have as Americans. It's considered a defined contribution, whereas pensions are defined benefit. You trade time working for an employer, and you get a defined benefit every month as a pension. Defined contribution means that you put in the money, you contribute, and then whatever amount you have at retirement, that balance, that's your money, and it's up to you then to create an income in retirement. There isn't a defined benefit every month that you get paid. You define the contribution that you want, so the money you put in and how you invest it determines what you end up with by the time you retire. And whatever is in that account at that time is what you need to then create your own income with. So you have flexibility to take out however much you want, but then you also have responsibility to figure out how much is the right amount to take out every month or every year to last as long as you need it to last. So this is through your employer, whereas an IRA is outside of your employment. You can set it up as long as you have earned income. You can set it up on your own at a custodian or a broker dealer. A 401k is set up through your employer. So typically when you start employment, they'll send you through an orientation packet, and they'll say, you can start funding your 401k after 1 year of working here full time. And they might say, and there's a match of like 4%. So some 401ks have matching from your employer. And again, the 401k is pre-tax, so that the money you put into a 401k or a pre-tax 401k goes in as a tax deduction. Essentially, it's not taxed on your paycheck, and then when you go to pull the money out one day, it becomes taxable income after age 59 and a half. That's the 401k. Any questions
Sorry, I
on that one,
couldn't
Marcia?
find.
Or we can do that?
Yeah, no, sorry, I couldn't find my unmute button here.
Okay.
Yeah. Oh, I did have a question. Is there a way that people can combine, say, like a personal IRA with, or I don't mean combine, but maybe like strategize where you're getting the employer match and then also maybe doing some contributions on your own outside of your employee plan?
Yeah, absolutely. So you could do both at the same time. The IRA, if you're under age 50, is $6,000. You can put into that. The 401k is $20,500, and you could do both. You could put them both in the same year, and they're kind of mutually exclusive. They don't really limit you on either one. And then, some people, they want to get the full match first and prioritize that. So if your employer is matching 4 or 5%, you put in 4 or 5% of your compensation. So if you're making $100,000, you would put in $5,000, and your employer would match 5. Now you have 10 total. And then you could put in the other 6 into your IRA. Now you have $11,000 for retirement in that year. And then that's kind of the other consideration. There's employer matching as an option with the 401k. Some employers do like a profit sharing at the end of the year, which isn't necessarily a match. They just choose to share profits based on a percentage. Some employers do that. That doesn't necessitate you funding. It's just an employer match. Some 401ks allow you to take a loan out of it, which essentially reduces your investable money in your 401k. So you're kind of robbing the future returns to be able to take money today. And then the 401k plan usually sets an interest rate, which can be favorable. These days, interest rates are rising. So, maybe around 5 or 6%, you can get a 401k loan, and then you pay it back every month, and you're basically paying yourself back into the 401k. And then early withdrawals and penalties. Go ahead, Marcia.
Yeah, can you talk a little bit about what kind of penalties happen when you withdraw money from a pre-tax account?
Yeah, so if you're pre-age 59 and a half and you're doing what are called like early withdrawals or non-qualified withdrawals in a 401k, you get taxed, which is whatever the income is on what your tax bracket is, regular income. And then you also get penalized, which is about a 10% penalty on whatever you pulled out. So if you pull out 10K, you're going to pay $1,000 of a penalty, and then you're going to pay whatever your tax bracket is, maybe another couple grand to federal and state taxes. So you're only going to net maybe $6,000 off of 10K, as an example, if you pull it out early. So a loan is a way that maybe
that can hurt.
Access it. Yeah, definitely not ideal. So a loan is a way that some people kind of skirt around the penalty and take the loan, but it's not all, not all good news, because you're taking away your ability to have that money grow in your 401k.
Mm-hmm.
But it's an option if your employer allows loans. Yeah.
All right. I was excited to. Oh, sorry. I was just saying I was excited about this when we talked about this one in our pre-webinar preparation. So I'm excited to have you talk about this one.
Yeah. So this is something called a solo 401k or an individual 401k. They're kind of used interchangeably. And I'm a big fan of these for people that are business owners and they don't necessarily have any full-time employees. Or if you're like a 1099 worker, maybe you do like some side hustle stuff, or that is your hustle, that is your job, a contract worker, and you have a 1099 income as self-employment income, but you don't have any other full-time employees. Or if you're a husband, wife, or you have a spouse scenario, both spouses can fund a solo K. And now you can both fund, if you're working in the business and you don't have any other non-spouse full-time employees. And it's just a really cool option because you don't have to deal with a lot of the kind of compliance headache of setting up a 401k when you do a solo 401k, but you're still allowed to get the benefit of the higher income, the higher limits on how much you can fund. So you could put $20,500 into a 401k that you own as a soloist, and you can also fund your own profit sharing, so you get a deduction from profits, and you own it, and there's no income limits. So someone asked, is there income limits to putting money into an IRA? Yes. So for an IRA, you actually make too much money in the eyes of the IRS, and then you're not allowed to get a deduction. So you actually need to be aware of that. Some people think that they're going to get a deduction on their IRA automatically if they put money in, but if you're over the income limit on your taxes, it becomes a non-deductible IRA. So basically, you don't get any deduction on your IRA, and same with the Roth IRA. So with the solo 401k, there are no income limits. You can make unlimited income and still put money into the solo 401k or the solo Roth 401k. So that's a way to get around the income limits. And to give you a rough estimate, if you're single, so filing single, and you do have an employer plan like a 401k plan available, you're not allowed to fund an IRA when you make over around $68,000. That's kind of when it starts to phase out. So $68,000 if you're single. If you're married, it's about $109,000. So once you start making more than that amount of money, you get phased out of the deductible, benefit of funding an IRA. So that's a good question. Thanks for asking that.
Yeah, really good
Any questions
question.
on that?
I think we're going to hold one of these questions until we have a chance to cover Roths, and then we can address some of the other things that have come in here. Let's talk about 403Bs.
Yeah, 403B is typically for like government entities or nonprofits. It's basically the same as a 401k. They're just two different tax codes. One's more for private entities, one's more for government or nonprofit entities like a hospital or a school district or another nonprofit. And it's the same thing. You get a deduction, and then the money is tax deferred later. And the whole idea is to invest it and grow it tax deferred. And then when you start to pull it out, you can decide how much money to pull out and pay tax on that money at that time. So that's the 403B. Some have matching, some don't. It just depends on the entity if the employer matches your contributions. Yeah. Should probably move to that. And then 457 plans. This is actually a really cool one. A lot of times, if you have a 403B, there's a 457 plan. So just to recap, not to confuse us, there's the 401k, the 403B, and the 457. And I'm actually a really big fan of the 457 because it has a little bit better features than the 401k. But first, let me just mention that you can do both at the same time. You can do a 401k and a 457, and you can fund them both $20,500. They don't cancel each other out on their limit. Mm-hmm. Same with a 403B and a 457. If you have access to a 457, you can do the 403B and the 457 in the same year, which means you can defer like $40,000 of income in 1 year if someone's in that position. Another cool thing about the 457, yeah, go ahead.
The question is, so you would have to have your employer be sponsoring a 457 in order to access this. Is that correct?
Yeah, exactly. This is for anybody that's an employee of an entity, a hospital, a school district, something like that. They tend to be government employees, and they offer the 457. Sometimes they call it a deferred comp plan. So you'll just have to ask and make sure that that's a 457. Another cool thing about the 457 is once you leave that employer, the 457 money that is in there, you can take it out without any penalties at any age. So usually with retirement accounts, you have to wait until 59 and a half, pull the money out without any penalty, the 10% penalty. With the 457, you can be 50 years old, 35, 40. And if you leave your employer and you keep the money in the 457, you can now pull the money out and not owe any penalties. It's kind of a way to access your money earlier. You still have to pay tax, if it's tax deferred, 457 money. But that's a really cool plan that I feel like a lot of people aren't aware of if they have access to it.
And you said there might be a Roth option available. I know we're going to go into Roths.
Yeah, so we'll go into the Roth next. Yeah, there with all these plans, there might be a Roth option. You'll confirm that with your employer, but we can move to the next slide and I'll get into the Roth more. So Roth is one of the senator's last names, and I think in the 90s, early 90s is when it came about, where you can now put money into retirement accounts after tax. So basically you get taxed on the money, you're already taxed on it, it's just your money like in a bank account, cash essentially, and then you put it into your IRA, your Roth IRA, and now it grows. If you invest it, it grows tax-free essentially. So when you go to pull it out, any distributions off of the gains, what you put in, interest, dividends, whatever is in that account is now all tax-free money. So I'm a big fan of the Roth because you get the benefit of the growth and you don't pay tax on the growth. You get to pull it out after you grew it tax-free. Whereas the IRA, in some ways, you're kind of growing it to grow your tax bill. It depends on your tax bracket, but you're growing basically the money you're giving to the IRS in an IRA. Whereas a Roth, you're growing it all for yourself. Now, granted, you don't get the tax deduction today, but it's very much a kind of a future-oriented philosophy where you're saying, I want the money to be tax-free when I most need it, which is when you're not working. So
if you're above age 50, you can fund an additional $1,000 into your IRA. Next year, the IRA limit goes to $6,500, and then you could do an additional $1,000 if you're over age 50. So $7,500 total is your max over age 50 in 2023. This year in 2022, it's $6,000 plus another $1,000 if you're over age 50. So $7,000 is your max in 2022. $7,500 is your max in 2023.
And then there's also income limits. So you can also make too much money to fund the Roth. So you'll want to make sure to track that and know how much you're making before you put it in. Go ahead.
Yeah, so if your income is vastly changing, that might be something you need to talk about with your financial advisor, CPA. Make sure that it makes sense to contribute how you've been contributing before.
Yeah, just to give you a rough idea, it's about $129,000 if you're filing single when you start to phase out of being able to fund a Roth. If you're married filing joint, it's about $204,000. So if your income is in that range, what some people do is they wait until the year's over so they know how much they're making, and then you can fund your Roth IRA up until you file taxes. So up until roughly April 15th, you can actually fund it for last year. So you have 4 months after the year's over to get money in the past year. So it's a way to kind of get a year back and also confirm your income. That way you don't have to deal with undoing it if you made too much money and now you have to take the money out. It's kind of a pain.
Mm-hmm. So is there a catch-up option for all the different types of retirement plans, or is it just for Roth IRAs?
Yeah, typically there's a catch-up in all the retirement plans. So for the IRA, if you're over, and they all trigger at age 50. So for IRAs or Roth IRAs, the catch-up is $1,000. You get a $1,000 bonus basically. And then for the 401k, it's $6,500. So you can put an extra $6,500 if you're over age 50. That's for the 401k, the 403b, the 457. And then next year they're increasing those limits So if you're over age 50, you could put 30,000 total in 2023 with the catch up if you're over age 50.
We're getting some more questions in, but I'm going to hold some of these till the question and answer period at the end. I don't want to get too off track, and I do want to keep going on Roths. So let's go ahead and finish this section up, and we do have some designated question and answer time. By the way, thank you everyone for putting in your questions. We will try to address as many as we can.
Yeah, we'll get to those. Thanks for asking. Great question so far. So this is basically what I was talking about. There's designated Roth accounts. So you have to actually select if you're going to fund your 401k. Your employer may or may not have the Roth option, so there'll be a drop down if you go to do contributions, and you'll select the Roth option. And the Roth option allows you to put in money after tax. You don't get a tax deduction today, but you're growing your tax-free assets for the future. So those are two separate buckets essentially, and you could do them in the same year. You could do like 10,000 in the pre-tax and 10,000 into the Roth. That's an option, but between the two, the max is the max, 20,500. If you're under age 50, and then any matching that your employer does is always pre-tax. The employer match is never a Roth match, at least as of today. So if you're funding the Roth, you basically get both. You get the Roth that you're putting in, and you get your pre-tax match. So you'll have two buckets your employer matches. So that's kind of a cool way to get tax-free assets and tax-deferred assets in your retirement plan. And then this is something called a Roth conversion, especially for people that put money in maybe early on in their career, pre-tax, and now they're like, wow, I didn't know the Roth was such a good idea. You could do tax-free money, and I want to switch it. Basically, you can trade or convert pre-tax money to a Roth any year at any income limit. So there's no limit on how much money you can make and still do a Roth conversion. So if you have $100,000 in a 401k pre-tax, you can convert it to Roth. Oftentimes your employer allows it while you're still working. Otherwise, when you're done working, you roll it to an IRA. So if you have $100,000 into an IRA, you could convert it to a Roth IRA in 1 year. Now the caveat is you have to pay tax in the year that you convert it. So you would basically be adding $100,000 to your taxes in the year you convert it. And someone would say, well, why would I ever do that? That doesn't make, I wouldn't ever want to add $100,000. An example would be like if someone's taking a year off, a sabbatical, or if they're just in job change transition and now you're not making any money or you're at a really low tax bracket, that would be a great year to do a Roth conversion and fill up some of those lower tax brackets and pay the tax, and then in the future you'll get that money tax free. And some people might argue, well, if I'm going to be retired later, won't I be in a lower tax bracket? Well, you might be, maybe not. Part of that depends on what the IRS is doing with tax brackets, and then part of it is realizing that you're still going to be wanting to have a good lifestyle, so you're still going to have income, whether it's your Social Security, if you have a pension, if you have real estate income, all that stuff's going to hit your tax return. So you might not necessarily be in a lower tax bracket. And
this is a good
psychological
question.
benefit. Yeah, go ahead.
A good question came in, can we spread the Roth conversion across multiple years, or do you have to convert it all in 1 year?
Yeah, you have freedom, you have flexibility however you want. So a lot of people do kind of Roth conversion strategies where they, this is the best time to do it at this time of the year because you know how much income you are going to have, and you can fill up a tax bracket if you know how much income you're going to have. So for example, I'll just use an example. Let's say you're married filing joint and you're at $70,000 of income. So you're in the 24% tax bracket. You still have another $19,000 before you jump to 32%. So you can convert $19,000 at the 24% bracket before you jump to the next bracket. So you can wait, but you do have to do it before the end of the year. You have to do a
So
Roth
it's not
conversion before
like
the end
where
of the
you
year.
can, it's not like where you
Yeah.
can do it like contribute afterwards. So yeah.
Yeah, and you
All
used
right.
in the past we were able to undo it. You could recharacterize it, but the IRS kind of got rid of that. I guess they thought people were gaming the system too much by doing that. So you really got to be confident that that's what you want to convert, and you have the tax. You have the tax to pay for that Roth conversion. I wouldn't really recommend to do a conversion and pay for the tax with the IRA money, because that's kind of defeating the purpose. You want to pay the tax bill with just regular cash that you have, not with retirement money.
Mm.
And then the
You talk.
backdoor Roth. So
Oh yeah.
this is for someone that's over those income limits that I talked about. So if you're married filing joint and you're over, approximately a couple $100,000 of income, they call it the backdoor Roth or a fund and convert. Basically, you're allowed to fund an IRA at any income limit. You just don't get the deduction, and then you can convert it, in the same year, tax-free. So it's kind of silly when you think about it. Like, why is the IRS making us fund an IRA and convert it to get into the Roth? That's just, I guess, in their infinite wisdom, they make us do a backdoor Roth and convert it. And the big thing here is that it works best when you convert all of your IRA money. So you don't want to only convert part of your IRA money, because then you're going to be taxed. And if you have any other IRAs out there, so if you have a STEP IRA or a simple IRA or just a regular IRA, it's not really that great of a strategy. The backdoor Roth really works when you have no IRA money. You put $6,000 in, and then you convert to Roth, and now it's a tax-free, Roth conversion, and you got money into the Roth IRA while being over the income limit. That's what the aggregation rule is. They aggregate all your IRA money to determine if you're going to get taxed. So it's best if you just do 100% Roth conversion.
This can be tricky. It sounds like definitely something to talk to your financial advisor about.
Yeah, for sure. It's easy to mess up, and it's good to just get a second set of eyes to make sure you're doing it right. And then this is talking more in terms of like retirement income creation, like creating a retirement income, and what are some strategies to create the income. And you can basically phase one way is to phase your retirement in basically tax buckets. So you can have your taxable money, which would be like cash, or in just a regular brokerage investment account, non-retirement account money. And then you could have your tax deferred funds, that'd be like your 401k, 403b, IRA, and then you could have your Roth, your tax-free money. So you have those three buckets with which you can then decide how much money you want to draw from each. And on the next slide, I talk about a good way to kind of sequence those. In general, if you want any of your dollars to grow the longest, it'd be your tax-free dollars, it'd be your Roth. So if you can help it, I like to have people spend that last. Because if any of your money doubles, you want your tax-free money to double. That'd be your Roth money. And then first, you probably want to spend your taxable money because you're not really getting any benefit for waiting. And then the pre-tax money would be kind of in the middle. That'd be your second stage, where you're going to get taxed on the way out, but you're still getting a deferral until you pull the money out. You're not getting taxed until you pull the money out. So that's one way to think about staging your retirement income and creating phases, in each, decade of retirement. For example, 60s, 70s, 80s is one way to think about it.
And I know that this kind of strategy is exactly what advisors do to help clients say, okay, this is how we're going to plan out your cash flow in retirement. Make sure it lasts.
Yeah, exactly. Because the whole name of the game is creating income that maintains, a lifestyle that you want. And In the past, the defined benefit plan, the pension kind of did that for us, whatever the pension was, which Social Security is a type of pension. But now we kind of got to create our own pension, whether it's with retirement accounts, brokerage accounts, rental income, those types of things.
Yeah, and actually, that's why I went back to this slide, because we didn't really talk about the different types of things you can do outside of retirement accounts. We did have some questions about muni bonds. If you can maybe touch on that and maybe talk a little bit about how some other type of assets can play into the different buckets in retirement.
Yeah, muni bonds, the main characteristic that people like that is because the dividends or the interest, the yield, the income that's created on munis is not subject to federal tax, and oftentimes it's not subject to state tax. So if you're in California and you have a California muni bond that's paying like a 4%, interest rate, then that interest isn't taxed on federal or state. So, if you're in like the 30% tax bracket, it's as if you're getting a 30% bonus by not being taxed on those income streams. So that's kind of the selling point, if you will, of muni bonds. Now, that being said, that they're still considered fixed income bonds, and this is adding my 2 cents in. If you have a long-term time horizon, which most of us, if we're living longer, just because we retire in our 60s doesn't mean we need our money in our 60s. We still have decades possibly till we need money. And we still probably want our money to grow, because as we're seeing today, inflation is real. Costs are rising. So if you lock in a 4% muni bond, even if it's tax-free, in 10 years or so plus, all of a sudden that income isn't keeping up with the price of goods. So, muni bonds might be good for a shorter term, play. If you have a goal of like maybe sending kids to college in a few years, or buying a house in a few years, and you kind of just don't want your money in cash, muni bonds might be a way to create some income. But it's often touted as a retirement tool, and it definitely can be. I'm just saying, be aware of the fact that it's fixed income. Muni bonds don't really grow. You're not investing in a business or an equity that grows and pays a dividend. So it's more of a fixed income thing, which is a tool that people use, especially in the higher income tax states.
All right. Thank you so much for the question there. Thank you for answering that question, and I hope that we answered that. If you want to put in the chat if you had any more questions about that. All right. So can you talk a little bit about required minimum distributions as far as for like 401ks versus Roth accounts? So talk about RMDs a little bit and what they apply to.
Yeah, absolutely. That's another huge benefit of the Roth. The Roth IRA, in particular, does not have any required minimum distributions. So when you hit age 72, there's no one telling you have to start pulling money out. The main reason is because the money's already been taxed, so there's no benefit for the government or the IRS to tell you to start pulling money out, because they're not going to get any tax revenue for that. Whereas with the tax-deferred money, the IRS is making sure that they still get some tax revenue, and the required minimum distribution is the way that they do that. So that's another big reason why people do the Roth, is because you're not subject to any required minimum distribution. Good question.
Yeah, that is a really good question. Can you maximize, like say a 401k and a 401k Roth in the same year?
Those will offset each other. So if the maximum in a Roth 401k is $20,500 for the employee contribution, then you can split that between the tax deferred and the Roth. But you can't do 25 in each one. You have to split it. So you can do 10-5 in the pre-tax and 10 in the Roth, or however combination you want. But the cap is $20,500 total between a tax-deferred 401k and a Roth 401k. Good question.
All right.
Good point of
That's a
clarification.
really good question. Can you talk a little bit about how the Roth can help reduce your income tax basis?
Well, Roth doesn't reduce your income tax today. The Roth IRA. We'll use the Roth IRA for example. Let's say you put $6,000 in to a Roth in 2022. You don't get any tax break today. But let's say when you're 60, and if that 6,000 grew to 12,000, that 12,000 is all tax free. You don't pay tax on any of that money. So, that's the big benefit, is it becomes a tax free asset in the future.
All right. Here's a good question, maybe beyond the scope of this webinar, but I thought we would just mention it. Do you know much about if I pass away, how will my retirement accounts be handled?
Yes. So that's a fairly recent rule, a new ruling that they passed, which changed things. So now it's basically a 10-year window that your beneficiary has to withdraw your retirement funds. So if you die with a 401k or an IRA, your beneficiary has 10 years to pull that money out, and they can do it at any amount within that 10 years, just as long as within 10 years it's pulled out. Otherwise, it gets like 50% penalties and stuff like that. So that's not really an option. In the past, you could stretch it out for life. You could have them do a lifelong. And a spouse still can stretch it out for life. It's if you have a child, a son or a daughter. Now it's a 10-year window. But the benefit of the Roth, another benefit of the Roth, is none of that money is taxed to your beneficiary. So, they don't have to think about tax aspects. The Roth is tax-free to them as well, which is another reason to spend the Roth IRA last in retirement if you have any legacy planning type goals, because that's the best money to inherit is Roth money because it's tax-free.
All right. Well, that's all about the time we have for questions today. Such good questions. If you had a question we weren't able to get to it, go ahead and leave your information in the chat so we can contact you if we need to get a hold of you. And we want to again thank Eric for being here and for the organizations that have worked with us to bring you this webinar today. Thank you so much for attending. Look for an email soon with a link to the replay of this event. And you're welcome to share that replay with friends and family, and also to watch it yourself again if you would like. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. I'm just getting some extra questions here and I'm going to save those. And again, thank you so much for coming. Advicechaser.com, just click on the link to find an advisor. And we'll see you at another webinar soon. Goodbye, everyone.
Bye.